Okay, so we're still looking at this question for Galway PLC. Okay, manufactures and sells a single product. The following budgeted stroke actual information is provided in relation to the production of this product. Okay, so we've got this information here: selling price per unit, direct materials per unit, and this the rest of that other information. Right. So the details for the months May and June 2010 are as follows. Actually, let me bring this near the solutions. So, production of product A in May, they're making 500 units. In June, they're making 380 units. Sales of product A in May, they expect to sell 300 units. In June, they expect to sell 500 units. Fixed production overheads are budgeted at 4,000 euros per month and are absorbed on a per unit basis. The normal level of production is budgeted at 400 units per month. Okay, then we have this other information. Other costs, okay, fixed selling, $4,000 per month. Fixed administration, $2,000 per month. Variable sales commission, 5% of sales revenue. Okay. There was no opening inventory of product A at the start of May. So here we're now going to find the profit for both months using marginal costing. Okay, so let me just bring this information here. So usually step one is to find the closing inventory. Okay, closing inventory, we already calculated it when we were dealing with the thing, absorption costing. Okay, so we get the closing inventory for May. Okay, this is usually can be your step one. So how you get your closing inventory? It's your opening inventory plus production, meaning when you add your opening inventory and your production, it means this is all the goods that you have in your factory. Everything you have. The goods that you started with and the goods that you made. So in total, it's all the goods that you have in your factory. Then you subtract the goods that you sell, and that will give you your closing inventory. So from the question, they said there was no opening inventory. So it is zero. The number of units produced in May is 500. Okay, colleagues, for those who will be saying, where did that 500 come from? Here is this 500 here. It's the one we're using. Sales, this 300, where is it coming from? It's coming from here. 300 units. So 0 plus 500, 500, then you do your tabulations here, and the closing inventory is 200 units. Colleagues, any questions before we proceed further? Any questions or queries? Okay, so step two, this is where we find our total cost per unit. This is what we're going to value, okay, our inventory, right? And since this is marginal costing, we're only focusing on the variable costs, okay? The variable costs in the production of the units and the closing inventory. That's what we're going to value it at. So the total cost per unit, okay, or the marginal cost per unit, right? Direct materials, 8 euros, variable cost. Direct labor, here, 5 kwacha, 5 euros. Variable production overheads, 3. Okay. These numbers are coming from where? Here, colleagues. Here. These numbers are these ones here. Right? Yes. So you're going to say 8 plus 5 plus 3. That will give you 16 euros. So this is what we're going to use to value our inventory. Okay, marginal costing uses only the variable costs, variable production costs when valuing inventory. Okay, colleagues, there is no fixed production cost here. Remember, marginal costing separates costs into variable costs and fixed costs. And when we're valuing our inventory, we're valuing it with the variable production cost. Okay, the variable production cost per unit. Any questions before we go to step 3 where you make the profit statement? All right. As always, we're going to start with the sales revenue. Sales revenue is the selling price per unit times the number of units sold. Okay, sales revenue, selling price per unit multiplied by units sold. So our selling price per unit, here it is, here in the equation, 50 euros. Number of units sold, here in the equation, 300. So 50 times 300, that is 15,000 euros. Right? 15,000 euros. Then our cost of sales. So usually start with opening inventory. Okay, but in this case, there was no opening inventory. Okay, so we're going to look at the units produced. It would be on top here. You would say opening inventory, and then yes, the number of units multiplied by that 16 euros. Okay. So our production costs, number of units produced multiplied by the variable cost per unit. All right. This variable cost per unit, we're going to use it to value the units produced, our closing inventory, and if there was any opening inventory, we value it with it. All right. So we produced 500 units. Variable cost per unit is 16 euros. So 16 times 500, 8,000 euros. All right. So if we had opening inventory, we would have added it with the production to get the total cost of goods available for sale. All right. But in this case, we don't have any opening inventory. So what we produce is basically the total cost of the goods available for sale. All right. Now we want the cost of the goods sold. Okay. So in order to get the cost of the goods sold, it's what you produce, or basically the total cost of goods available for sale, or the goods that you have in your factory, okay, their value minus the goods that you sold, and with the goods that you've remained with. All right, that will give you the cost of the goods that have been sold. Okay, colleagues, any question on that? To get the cost of the goods that have been sold, is the total cost of the goods available for sale, or the goods you had in your factory, minus the goods that you've remained with. That gives you the cost of the goods that were sold. Okay, so our closing inventory, 16 euros. Our closing inventory, 200 units. So 16 times 200, 3,200. So the cost of sales, you're going to say 8,000 minus 3,200, you get 4,800. Any questions? All right. Then remember, in marginal costing, you split variable costs and fixed costs. So we've also got our variable sales commission. You said 5% of sales revenue. Sales revenue we tabulated 15,000. So 5% of 15,000, 750 euros. All right. Yes. So get our total variable cost. Okay. 4,800 plus 750, 5,550. This is our total variable cost. All right. Then next we need to get our contribution, right? Contribution, total sales revenue minus total variable costs. Contribution, the money that's left to cover the fixed costs after you've deducted the variable costs. So I'm going to say 15,000 minus 5,550. Our contribution is 9,450. Okay, now we are done with the variable costs. We are remaining with our fixed costs, which are treated as period costs. The period cost is just the cost you incur for that period. Okay, so in this case, it's the cost that we incur for the period of May. All right, so our fixed production overheads, okay? Fixed production overheads, this number here, this one here, this one here, fixed production overheads are budgeted at 4,000 euros per month. Is the one which I'm referring to here, 4,000. Our fixed selling costs, fixed selling 4,000 euro per month here. Our here, fixed admin 2,000 euros per month. Okay. So 4,000 plus 4,000 plus 2,000, you get 10,000. What's this? You get 10,000 euros. That's the fixed, total fixed costs. Okay. So our net profit is the contribution net profit is the contribution minus the total fixed costs. 9,450 minus 10,000, you get negative 550 euros. Any questions, colleagues? Okay, then if they ask you to do profit reconciliation, okay, you can use this formula for the profit reconciliation. Okay, if you want to start with your, if you want to get your absorption costing profit, it's your marginal costing profit plus the fixed overhead absorption rate multiplied by the closing inventory minus the opening inventory. Okay. So when you do these tabulations, you have to get the profit that you got with absorption costing. Okay. If you want to get the marginal costing profit is the absorption costing profit minus the fixed overhead absorption rate multiplied by the closing inventory minus the opening inventory. Meaning, in order to get your marginal costing profit statement, when you do these tabulations here, once you do these tabulations, you have to get the profit that you calculated in for marginal costing. Okay, that's how you know if you're correct or wrong in the exam. All right. So in this case, I started with, well, I want to get the marginal costing profit. So it's the absorption costing profit minus the fixed overhead absorption rate multiplied by closing inventory minus opening inventory. With absorption costing, we got profit, a net profit of 1,450. Okay, this was the net profit for absorption costing. Our fixed overhead absorption rate, this one here, fixed overhead absorption rate was $10, 10 euros per unit. Okay, so our absorption costing net profit 1,450 minus the fixed overhead absorption rate multiplied by 200 multiplied by the closing inventory minus the opening inventory. All right, so you're going to say 200 minus 0, you get 200 units. 200 times 10, you get 2000. Then you say 1450 minus 2000, you get negative 550. Okay, which is the marginal costing profit, which we got here, negative 550. Yes. Any questions, colleagues?